You ever look at the economic headlines, stocks are hitting new highs, GDP is growing, and then you look at your own bank account and think, wait a minute, something here just doesn't add up. If that feels familiar, you are definitely not alone. So let's get into what's really happening.
I mean, it's probably the biggest disconnect out there right now. We keep hearing about this booming economy, but for so many people, things just feel tight. Groceries cost a fortune, rent keeps climbing, and just getting ahead feels like an uphill battle. So what gives? Is the data just flat out wrong, or is there a much deeper story we're all missing?
Well, the answer really lies in this idea called the K-shaped economy. It's a super powerful concept that explains this whole paradox. Just picture the letter K, right? After some kind of downturn, instead of everyone bouncing back together, like in a V shape, the economy literally splits in two. One part starts climbing up, while the other part trends down, creating these two completely different realities happening at the exact same time.
And this slide, it just lays that divide out perfectly. On that top arm of the K, you've got the winners. We're talking higher income households, folks who own assets like stocks and real estate, and of course, the big corporations. But then on that bottom arm, you have the people who are really struggling, lower income families, renters, and a ton of small businesses. This is exactly why a single headline about the economy can feel so totally off.
So how does a split like this even happen? It's not just random chance. There are these really powerful forces, let's call them engines, that are actively pulling the two halves of the economy in opposite directions. Let's break down the four main ones so we can really get what's going on under the hood. Okay, engine number one is this massive race between assets and wages. Over the last few years, the value of stuff like stocks and houses has just gone through the roof. So if you already own those things, fantastic, your wealth grew like crazy. But for most people who rely on a paycheck to get by, wage growth just hasn't kept up, not even close. And that creates this huge widening gap between the owners and the earners.
Second, and this is a big one, it's not just that there's inflation, it's about what is inflating. When the prices of the absolute must-haves, the things you cannot live without, like rent, food, and insurance, go way up, it just hammers lower-income households. Why? Because those items make up a much bigger piece of their monthly budget. They feel that squeeze way, way more intensely.
The third engine here is credit. Think about it. High interest rates make it super expensive to borrow money. That is a huge problem for small businesses that need loans to grow, for families trying to get a mortgage, or really for anyone who relies on credit cards to make ends meet. Meanwhile, big companies and wealthier folks, they can handle these higher rates much, much more easily. And finally, the fourth engine is the job market itself. It's not just one big thing. It's broken up into segments. You have some jobs, maybe in tech or finance, where there's a shortage of skilled people, so employers have a ton of power to demand higher pay. But then you have all these other jobs with very little bargaining power, and they're way more vulnerable to layoffs and stagnant wages. It just pours fuel on that income divide. Okay, so understanding what's driving all this is really the key, because it helps us start to see where this whole K-shaped thing might be headed next. For investors, or really anyone just trying to plan for their future, there are pretty much three main scenarios we need to be thinking about. First up, we've got the best case scenario. The recovery broadens out. This is the world where that bottom leg of the K finally starts to curl upwards and catch up at the top. It's a move back toward a more traditional recovery where, a rising tide actually lifts all boats. So what would we actually see if this happens? Well, the key signals would be inflation really cooling off, especially for those essentials. You'd see real wage growth, and that means paychecks are actually growing faster than prices for lower income folks. And, this is critical, you'd see the number of people falling behind on their loan payments finally stabilize. In that kind of world, the market might do well, but you'd probably see the gains spread out beyond just a handful of giant companies. Then there's the second possibility. The K just persists. This is where the split becomes kind of the new normal. The big headline numbers look okay, maybe even good, but that underlying stress on the bottom half of the population just never really goes away. The signals here are a little more subtle. Inflation isn't spiraling out of control, but essential goods stay painfully expensive. You see wage gains, sure, but only for certain jobs in certain sectors. And you start to see this slow, steady creep up in defaults on things like car loans and credit card debt. In that kind of environment, stock market returns tend to get really concentrated in those super high-quality, stable companies that can handle an uneven economy. The third path, well, this is the one that's the most worrying. It's what we call a bottom-up recession. This is where the pressure on that bottom leg of the K gets so bad that it finally breaks. And that weakness doesn't just stay there. It spreads upwards, pulling the entire economy down with it. The warning signs here would be pretty hard to miss. We're not talking about a slow creep in delinquencies. We're talking a sharp spike. You'd see layoffs that start spreading way beyond just one or two industries, and companies across the board would start lowering their profit forecasts. This is absolutely the scenario where riskier investments, like stocks, usually take a pretty significant hit. So, with these three totally different possibilities, how can you actually tell which path we're on? The good news is you don't need a PhD in economics. You just need to know which numbers tell the real story. Think of it like a simple dashboard with the most important gauges. Let's take a look at what they are.
So here it is, your 8-point dashboard. First, you've got the job market, unemployment and jobless claims. Second, are wages actually beating inflation? That's real wage growth. Third, what's happening with prices for services and housing? Fourth, are people falling behind on their debts? Fifth, who's actually spending money? Everyone or just the wealthy? Sixth, how are small businesses feeling? Seventh, what are companies expecting to earn in the future? And finally, you have the bond market signals, things like the yield curve and credit spreads, which tell us a lot about risk and future growth.
And look, if there's one single combination to really watch for, this is it. When you see the job market getting weaker, people struggling to pay their bills, and stress showing up in the credit markets all at the same time, that's the trifecta. That is when the odds of a bottom-up recession start to get really, really high. Okay, so knowing what to watch is one thing, but how do you actually translate all of this into a practical strategy for your own money? The goal here isn't to perfectly time the market. That's the fool's game. It's about building a portfolio that's tough enough to handle these really uncertain conditions. You know, in a key-shaped world, there's a really clear difference in what tends to work. The stuff that holds up better, it's usually high-quality companies that have pricing power, meaning they can raise prices without losing all their customers, and businesses that provide essential services. And what's fragile? Well, that's going to be companies with a ton of debt and businesses that rely on a consumer who's already financially stretched to the limit.
So here's a super simple framework for how to act on this. Step 1, build a solid, durable core for your portfolio. Maybe that's a broad market index fund with a little bit of a tilt toward those quality companies we just talked about. Step 2, you can add smaller satellite positions based on which of those 3 scenarios you think is most likely. And step 3, and this is so important, always hold some cash or short-term bonds. That gives you stability and it gives you the flexibility, the optionality to jump on opportunities when they pop up.
Which really brings us to our final and maybe most important question of all. We tend to think of this kind of split as a temporary thing, something that happens after a crisis and then goes away. But what if it's not? With these huge, persistent gaps we see in housing, in job skills, and in wealth, is this divergence between the winners and the losers of our economy actually becoming a permanent feature of our world? That's something we all really need to think about.